Hi friends, my name is Amandeep Singh and I'm a CPA at Cloudiverse CPAs. A recent study by BDC reveals that close to 60% of owners of small business are aged 50 or older, and that means many will soon exit their companies. With so many baby boomer business owners heading to retirement, the coming years are a golden opportunity to buy a business in Canada. If you are thinking of buying a business, it is important to decide if you are going to buy the shares of a business or the assets of a business. Often, the person selling the business prefers the share sale, while the person buying the business, which is you in this case, prefers an asset sale. This video focuses on the advantages and the disadvantages of both the options. Please bear in mind that I am discussing the purchase of a business which is operated as a company. For other businesses, such as sole proprietorship or partnership, you as a buyer are only able to purchase the assets of the business. So friends, let's start with your preferred option of buying the assets of a company. The main advantages are, number one, you can pick and choose which assets to purchase and liabilities to assume, leaving the unwanted assets and liability behind the selling company. Given that assets would sell at fair value, which is the market value, this can create a bump in the tax cost of the assets whose market value is higher than its current tax cost for the seller. What does this mean for you? It means that you can save a considerable amount of money through tax savings. The future tax shield or tax savings can be significant depending upon the original value of the assets owned by the selling company. Number two, you are not responsible for any undisclosed liabilities in the business. You are not required to assume liability for non-union employees also, unless you elect to offer them new contracts. Number three, if you pay more for the assets than the value of the assets acquired, the additional amount paid is purchased goodwill. Now, how does this benefit you? The purchased goodwill is eligible for saving in taxes due to depreciation deductions. Every coin has two sides. You see, buying assets also suffers from disadvantages. These are, number one, you cannot save money by using the non-capital losses of the seller corporation. Number two, the seller may decide to retain certain assets which he or she does not want to sell. For example, the selling company may want to retain real estate and other non-operating assets in the business. Well, if you are interested in these assets, you are at a disadvantage by purchasing the net assets of a company because you won't be able to purchase those assets. Let's look at the option of share purchase. Number one, buying a company shares also means inheriting all the company's liabilities such as unpaid income tax, property taxes, GST, provincial sales tax, workers' compensation premiums, and payroll taxes, etc. Number two, you lose the ability to pick and choose which assets you want to buy. You might not need certain redundant assets in the business, and you will spend time getting rid of those redundant assets. Besides, these assets may not sell at a good price once you try to sell them. Number three, unlike the purchase of assets deal, you cannot write up the value of the assets to their fair market value. There is no change in the tax basis of the assets purchased. As a result, you do not save any money through added tax shield for the added fair value. 4. If you pay more for the shares than the value of the assets of the corporation, goodwill arises. However, it is not purchased goodwill, so it is not eligible for depreciation claims, which could have saved you money. Based on so many disadvantages of share purchase, you might want to purchase the assets. However, if you do so, take note of the fact that the seller might ask you to pay more for the assets than what he or she is asking to get paid for selling the shares to you. The primary reasons are: number one, the seller loses considerable amount of money as he cannot claim lifetime capital gains exemption on the sale of those shares. On the other hand, if a capital gain arises on the sale of shares and the corporation is a qualified small business corporation, the lifetime capital gain exemption, which is very considerable exemption, can be claimed by the seller to become exempt from all or a significant part of the tax on capital gain. Number two, an asset sale may activate the need for the seller to obtain more third-party consents to the transfer of assets. What does that mean? This means that it has a high time and money cost because of contracts, leases, licenses, or permits. Number three, there are two levels of tax for the seller when you structure the deal as an asset purchase. The first of these is at the corporate level, where the seller considers the tax consequences of the sale of the assets. The seller would then have the corporation redeem his shares and would at the second level pay tax on the deemed dividend that occurs as a result of the share redemption. What does this result to? This results in a higher tax and the complexity increases, which results in a higher accounting and legal fees as well. If you want to purchase the assets of a business, but the seller, of course, only wants to sell the shares, this situation not be a deal breaker for you. There are ways to get over this problem. You can employ specific risk management strategies to deal with the risk associated with the share purchase, such as the following: increased due diligence procedures, including for a search of liens, mortgages, and other unrecorded liabilities on those assets. Clarify to the seller that if there are unknown liabilities at the time of purchase, the former shareholders should be responsible for those. Get a lawyer to put this in writing as well. A right to set off unknown liabilities from the purchase price. A holdback of a portion of the purchase price to cover unknown liabilities. The decision to purchase the assets versus the shares frequently involves some negotiation between the buyer and the seller. Make sure to speak to your certified professional accountant, as this can give you valuable time and money saving tips. I hope you enjoyed this video. Don't forget to subscribe, comment, and like our YouTube channel. See you soon, and thanks for watching.